Okay, so you might actually spot, if you can see, it might be too small, but anyway. So got this recording on the 3rd of November 2020. Okay, so that's going into the US elections. And currently you can see at the time of recording, it was 11:15 at night. So that's, in the US afternoon, and this is going into the midnight, 1, 2 a.m. and going to the next day. So without spending too much of the stream, without explaining the backdrop, the macro backdrop of, did the markets take a Trump victory, positive or negative? Did Trump see Biden as a negative or positive for markets and so on? Without going into that, the only thing I will set this scene as is saying, understanding how we're going to trade between something called risk on and risk off flow. Okay, and by defining these kind of flows, understanding how they move, you sort of, it's a sort of a mental model of how the market should react. Okay, so I mentioned obviously a lot of this last stream, but the one thing, it's really worth going into this a few more minutes before we really get into the footprint, before we go into the ladders. So what I'll quickly go do now actually is, if I get my screens and I go to my main. So when I say risk, and if I mention this now, if anyone in the chat actually tells me what they know what is risk on, or if you look at risk off. Okay, so these are the two kind of like one of the main sort of kind of order flow you might get, and the kind of expectation of how you think markets might move. Okay, so with risk on, what we usually expect is the market deciding, anticipating that because of new information or new kind of flow, investors, institutions, or so on may want to take on more risk. Okay, so they want more risk, and from the sort of the institutional, the financial perspective, what we mean by more risk is therefore conversely more return, and the market sees that you get more return for your risk by looking at certain asset classes. So for example, if you invest in equities, it is widely accepted that they are perhaps riskier, let's just say that, as just to overly simplify, but they give you more return. Okay, and there's also commodities as well, in terms of certain investments there, because hedge funds like to express their view of the world in terms of economic growth or decline through things like copper or through things like oil. And so, of course, if you have positive expectations about economic growth, you would expect they're expressing their growth story through oil. Okay, so the market will start discounting this information if we have risk on, and then say, okay, probably the market's going to start buying up oil just based on this, and then oil will bid with, will start going up with equities as we move on, as we go into risk on. Okay, so what that happens is when we have risk on, you have equities going up, okay, or when I say bid, as in people are buying them, okay, and when we have risk on, you also generally have the equities up and bid as well, okay, and then you have your safe havens, what the market deems as safe havens. So when we talk about safe havens, we generally mean fixed income, or let's just say in this case the bonds, and other things, for example, like currencies, several of them, but let's just say for now, just to overly simplify, the Japanese yen. Okay, there's other things like the dollar, the US dollar, or for example, in terms of currencies, the Swissy, the Swiss franc. That sort of relationship comes and goes, and it's been more difficult. And of course, let's not forget also gold. We can put it here separately. So generally, the response is because generally of how the financial, the sort of the expectations of, you always have your wealth managers, or you're saying something, we're going to put 60% in stocks, 40% in bonds, and that sort of we rotate in and out based on confidence in the economy or things like that. So what you usually have is that if people are more risk taking, they want to take on more risk because they're comfortable, they'll usually come out of the bonds, okay, and use that money that it just came out of the bonds to buy up things like the equities or commodities and so on. So we have this constant rotation of in and out, okay, and because of that, you always have to remember that institutions, big players, pension funds, hedge funds, whatever, most of them have mandates where they can't be flat, okay, they can't go to pure cash. And there's this famous quote, with Ray Dalio saying cash is trash. Because basically, a lot of the time you're graded on a benchmark if you're a hedge fund or institution of how well you perform relative to others. and it's difficult to get a same kind of benchmarking performance if you're always flat or you're always in cash, and or you may be physically not allowed to do that. So you basically always have to have your money somewhere, and this is why a lot of places may have their money parked in bonds or in currencies, for example, like the yen, or for example in gold. Okay. So that's our risk on. So basically, let's say market's favorable, the outlook's favorable, and institutions will say, okay, we want to take money out of the bonds, put them into equities, so they will go down, okay, or they just get offered, okay, or sold. The same goes to safe haven currencies like the yen, and with gold it's a bit of a tricky one. So the relationship between gold being a safe haven investment or moving like a safe haven, it was really nice up until basically the virus, the pandemic hit. So from basically February, March, just this relationship of it being a safe haven, was really nicely behaved up until then. After that, it sort of came, it moved like a risk asset. Sometimes it moved like a safe haven asset, and so on. Yes, I will zoom in. Very good point. Thank you, Andy. Yeah, so there was this kind of strange relationship with gold, but let's say with the exception of the past year, okay, generally you would have gold as a safe haven. So in this case, if we have risk on, generally you would have the gold come down, and that's the very basics. So without overcomplicating it, without going spending an entire hour going just into this, because there's so much I want to get through in this stream, is just understanding this kind of relationship. Now, what happens, you might guess, with let me just zoom in a bit for you guys. Let's see. I am getting a few reports here of you guys in the chat about the clarity of the stream, so let me just double check. So so for those guys whose screen may not be clear, if you guys can just double check you're on the HD part of the YouTube stream or wherever you're tuning in from, just to double check if it's not on my end. But very quickly, just while we go through this. Okay, Vince is fine for you. Okay, yeah. So for those guys who, for those guys who might be blurry, just double check your connection to make sure you're on HD. Okay, then that's perfect. Okay, perfect. So in fact, if I now let's move this screen somewhat. Let's move it here, just so it doesn't block the chat. Cool. So risk on. Okay, so that's when institutions, investors, the market's discounting on them being optimistic about something. Because let's say vaccines are out, boom, that's optimism. Risk on. Okay, what's risk off? As in the market becomes fearful, as participants become fearful. We're not optimistic about the future because of some new information that's just hit. Okay, the biggest risk-off event, obviously, in the past year was in February, March, and so on, when it became clear the pandemic was, coming through, all these lockdowns and happening. So just imagine yourself back, a year ago, nearly now, into this sort of risk-off mentality. What do we mean? These institutions, until we're talking about extreme circumstances, but even then, you cannot go to cash. You have to put your money somewhere. Okay. So if the equities are getting absolutely destroyed because everyone's fearful and pulling out their money because of future economic growth, where do you park your money? So what you usually see in risk-off situations is that equities go down, as in they're sold, or we can say offered. Okay, commodities, because this is now this is where it gets a bit more trickier. But just to oversimplify, you may have, like, for example, copper and oil, because now global demand has absolutely just collapsed because of economic shutdown. So they would obviously go down and offered. Okay. Now, if I talked about the bonds and the yen and the gold, very simplistically, being your safe haven assets, you're sort of your port in the storm, where you can keep your money. What do you expect when you have risk off? Well, they will go up. Okay, not 100% true, because there are different things, like when you have the risk, different maturity risks, because bonds come in different maturities, like the 2-year bonds, 5-year bonds, 10-year bonds, 30-year bonds, and there's different risks of maturity. But again, I don't want to perhaps that's probably for another stream. This is we gotta get a move on a bit with me showing you all the fun stuff. But anyway, bonds generally bid, okay, or they go up. Safe haven currencies like the yen, but with perhaps not always in specific kinds of flow, but generally you would expect for it to also be up bid. And things like gold, in normal circumstances, except for in the past year, you'd also expect for it to be up and bid. Okay, so that's your very, very basic. Each market may have its own, nuances. Like the agricultural ones move a bit differently. The dollar moves a bit strange, where it actually during risk off, you might see people coming out of the dollar, selling dollars to buy the yen. But if you have prolonged risk off, people might treat the dollar as the ultimate safe haven. And actually then you see a reversal where people come back and just buy all the buy the dollar. So you see these kind of these flows morph and change over time, but we as intraday flow traders trading day in day out, we're only interested in perhaps the immediate sort of the immediate move. Okay, so very basically this is what we can surmise as risk on and risk off. Now let me just very quickly switch my ladder screen. So for those who may have just joined a bit later, we're now going to look at a recording from Trader Andy. He's one of the senior traders on the London floor. And this is him trading the nights going into the US selection. So very simplistically, we can say that we're getting, as you can see now from the way the markets will move, the market was changing so much between risk on and risk off. I had no idea how I wanted to treat, is a Trump victory good, or is a Biden victory good, or is a Trump for markets, or is a bad or good, or if Biden gets through, then we have stimulus. What does that mean for bonds and so on? So the market had no idea what it wanted to do, and as we'll see in a minute, the liquidity was very thin because we're trading out of normal cash hours, we're trading into overnight sessions, so it's a bit more difficult. And this is what we're going to watch in this recording where Andy was trying to get his feel through what you'll now understand as the correlation. Okay, because if I very quickly, just before we start now, flick back to the correlation of understanding this. So if you expect equities to go up on risk on, let's say, and the bonds to go down, then they will have a relationship. If there is risk on news, you will see it, both of them on your ladders, go like this. You'd expect the equities to start bidding up, perhaps more aggressively, and then the bonds to slowly come off. So if you see this rip, equities up, bonds down, you know that the market's already thinking, the participants are thinking in terms of risk on. Okay, but what happens if you're sitting there and all of a sudden you see the equities coming, they're selling off, and you see the commodities selling off, and they come off, and then all of a sudden you find the bonds catch a bid, they're going up, the yen is catching a bid, and in normal circumstances the gold is catching a bid. Okay, so then the market has flipped now into more of risk off flow. And in this video, you'll see how the market was constantly going between risk on and risk off. The bonds started selling off, the S&P, SPU started bidding. And then over the night, we reversed again based on how the polling and the results from the elections were coming through in each state. So as each state was reporting, it was trying to preempt, who had the majority, if any, to say a likely a Biden or a Trump win. And it was flipping between these constant states of risk on and off. So now if I very quickly now go to ladders, and as you might see from these streams, is I want to stop, I want to do a pit stop to answer a lot of questions. So, and because these videos, the way we recorded them, they take a bit of a long while to load. So we'll show you this one, I'll show you another one, and I'll show you my own one at the end. Because they take a while to load, I think that's a perfect opportunity to actually do a bit of questions. So just before I start it now, I see I already have a few questions. So let me just scroll through, guys, and see. Yeah, so Vince, absolutely excellent question. Excellent question, Vince, on why on some economic releases, do you have the bonds and the equities moving in the same direction? Perfect. Okay. So to answer Vince's question, this is because we don't have only risk on and off flow. That is only one type of flow you get. Okay, so I know I'm switching my screens here, but you may have order flow based on the market's trying to move around on what the central bank will do, the FOMC, the ECBs, or something. So for example, as you might have seen on the US CPIs this week, or other economic data. On economic data, because the FOMC or central banks base their actions on what a lot of the economic data is doing, because they have two mandates. In the case of the FOMC, to control unemployment and control inflation. With the ECB, it's only inflation. So when these numbers come out, it's telling you directly what the ECB already knows, what the FOMC already knows. And it's going to start telling you what they're going to start thinking, what the interests are, what the probabilities of how they're going to move interest rates around in the next year, 2 years, 3 years, 4 years, and so on. Okay. And what you might then have is that if inflation comes out soft or it doesn't come out hot, the economy is all running hot, we don't have high inflation, we have perhaps lower, or like the inflation is just not a thing, like we kind of saw in the CPIs, because in the CPIs we expected inflation to come out strong. They did not. Okay. What that means is that the FOMC has a bit more time to be as stimulative and keep interest rates as low as possible. As a one-to-one relationship, we've increased the probabilities that they probably now have more time to keep interest rates lower for longer, or at least we believe that more than we just did before the data came out 5 minutes ago, if that makes sense. And because they can keep interest rates lower for longer, that is what we would call being more dovish. Okay, so we have dovish or hawkish flow. Basically, what we can talk about in these kind of types of order flows is dovish is when the market, when the central bank is saying, you have different members in the central bank. Some are hawkish and some are dovish. The dovish participants, the voting members, are ones who are a bit more cautious. They don't want to raise interest rates as fast as possible. They want to be stimulative. They want to keep interest rates low, lower for longer. The hawkish members might say, it's fine, the data is improving. Okay, let's think about starting to normalize interest rates sooner rather than later. Okay, and when the markets, so when you have a bit more dovish expectations, that the expectations that the Fed is going to be a bit more dovish, i.e. stimulative. Okay, what does that mean? Well, equities love it because as a business, you have your interest rates are lower. Businesses can borrow cheaply for longer, so that's just generally good for equities because there's more cash to splash around. Very simply, okay. So in that case, you would have most of the time the equities up. Okay. Because we're looking at the bonds, and when we trade bonds as traders, we're looking at the futures. Okay, the futures are moving inverse to the yields. Okay. So when we, very simply, again, without going into this too much, when the Fed are keeping the interest rate set by a central bank is obviously very much tied to bond yields. So if we know that the central bank is going to keep rates lower for longer, the bond yields are also going to stay lower for longer, okay? Or they'll just discount and come off. As the yields come off, the bond futures price goes up. It's a direct relationship. So in that case, you have bond futures up, and then you have the yield down, okay? And then you have other things like the commodities or oil. Like oil might just say, hey, look, we're going to be stimulative. The economy is going to keep growing more for longer. Let's buy oil because there's just going to be more oil demands. So then you also get this like triple whammy in effect, where you also have commodities up, okay? So I segued into that a bit, but I think from Vince, that was an excellent question, and I was going to go into this a bit later, but anyway, to answer his question, we can do it now. So I think I spent a bit longer on that one, but don't worry, guys. At the next pit stop, I'm going to get back to the questions and do it, because I know we're probably itching now just to start this video recording. So let me just very quickly, I'll zoom around. Perfect. Okay. So again, US election night, and what you can see very quickly is the trader, as was telling me, and we all do this on the floor, the ladders he has on this recording is not an accident. Okay, these ladders are all there for a specific purpose based on what I literally just told you 2 minutes ago. Okay, so he has on the left here, in fact you may not be able to see this because of the chat, but don't worry, we will not be focusing this. He has the Aussie dollar, the Australian dollar, which is seen as a risk currency because it's tied to commodities. Okay, so that's a view. And here in this, if you can see my mouse, it's the copper. Don't worry if this is overlapped or anything, guys, because we won't be really looking at on the left side here that much anyway. But the one which is more important for us is the euro futures. Okay. Why so much the euro? Because obviously we're trading the currency, so it's euro denominated in dollars. So it's basically a proxy to look at what the dollar is doing, obviously, because we're trading the US elections. In the middle here, he's got gold, the gold ladder. These two markets here, this is the US 10-year, the ZN, the US 30-year, ZB. So this is the long end ladders. When I say long end, if we look at the curve, remember earlier I mentioned that bonds have different maturities. The 2, 5s, 10s, 30s, there's more of them, but when I say long end, we mean the ones that have the duration of 10, 30 years or so on. So it's got the long end because they're generally a bit more volatile and they move a bit more on these events. And we have absolutely everyone's favorite, of course, the S&P, the SPU on the right here. So as you can see, as you can already kind of figure out what kind of flow he's trying to understand. How is the market discounting this kind of flow? He's got his risk ladders, okay? He's got the copper, he's got Australian dollar, he's got gold. And you might be thinking, why Australian dollar? Why is that important? Well, again, it's a proxy for, it's a risk proxy as a currency, but also because we're now going into the overnight session in London at this time. And we're slowly going to, where basically the Asia Pacific region is starting, it's their main sort of trading hours. So you would think that perhaps for those, everyone is at their desks, the market might be there a bit more clear cut in what it wants to do. Okay, so because those guys are thinking there's more liquidity and the market's moving a bit more naturally. Because the issue with this kind of trading is you're trading overnight and the market's very illiquid. Or liquid, or or lack of liquidity. And now very quickly, because I'm going to talk about this, I'm sure some of you who are very, very familiar with the ladder, you're going to be like, well, okay, I get this. I know what a bid and offer is. I know what liquidity is. But I'm just going to go through it because some of you may not have seen this very before. So as a ladder, why are we always trading on ladders? Is basically where participants can come in and execute, orders through. But you can also see the kind of interaction you have between participants in the market auction, which we now describe as order flow, or the price action. Okay, so and every market obviously has a bid or an offer, if you can see my mouse in here. And some markets are thicker than others. Or what I mean by thickness is that the bid or offer just generally there's more physically more contracts available for you to enter in the market with or leave with. At any given time. So for example, if I was trading this live right now, you can see here in the ZN, in the US 10-year, that the best offer, there's currently 94 lots offered, okay? That means if I come in and I lift the offer, I buy 94 contracts, that's going to clear out this price here, assuming no one comes in and steps it out. We're going to clear this price here, and then we're going to trade into the next price at 80s here. And then we have to take out the 570 lot or combination of orders sitting on this offer here. So very, very simply, there's always this kind of two-way push-pull, a kind of tug of war where to move the price, you have to trade it with, there has to be enough traders collectively, or perhaps one person, to buy through orders to eat through the liquidity, or enough to sell again into the bid or hit the bid with enough liquidity to keep moving it down and down. And that's how the market then interfaces with, this kind of the buying pressure, the selling pressure. Perhaps there's someone sitting there with the bid and just constantly just eating liquidity, and we just stay flat at one price. And the way you guys see that and understand that, I've got, in fact, it'll be the last video I'll show you of one of my trading the oil inventories a bit later, seeing that very clearly and understanding that kind of auction. Okay, so that is a very basic 2-minute thing on the price ladder. But even if you've never seen the price ladder, just for now, don't worry about all the numbers you're seeing. And for you guys who may not, who are more familiar with the price ladder, don't worry so much about looking at every single tick and every single price. What I want you to really look at for this one is seeing how the market discounts and moves between risk off and risk on how it pulls back, which market is leading, which market is showing the way in terms of what the market's thinking, and so on. Okay, so let's start this. Now I will zoom out very quickly. I'll fit this to the page. So for those who, so I think as an exercise, if this screen now looks a bit zoomed out to you, if you can't see it so well, that's actually perhaps a good thing. I don't want you to focus on every tick by tick information. I want you to see how the markets are reactive to each other, because there's a correlation now between the markets. If the bonds are moving down, so the bonds here in orange, you should expect the S&P here to move up, and vice versa. If the S&P is collapsing and the market's thinking, okay, a bit more risk off, you will expect the bonds here in orange to start going up. Okay, you will see this kind of played out in gold and in the euro, but for now, don't worry so much about that. So for those guys watching, just focus on this part of the screen, the orange and the black sort of areas here. Okay, so let me start, and then I think we can even skip to the... Okay, so you're starting to trade the election now. So very quickly we can see, and I'll leave this running a bit while I'm talking so you can just see how the flow sort of moves. So it's around about now midnight in London, which means it's probably like 5 to 6 p.m. Around the US time, so mid-afternoon. And what's he done here? So if I actually, let me just zoom in ever so slightly, don't worry guys. Okay, so what's he done here? He sold. You see, if you ever want to see your position on these ladders, here's his position. He sold 40 lots on the ZB, and he's now long. He's bought 21 lots in the S&P. Okay, you can see his entry is his average entry. His short from these prices, and long in the S&P here. So very simply from this relationship, if he is selling the bonds and buying the S&P, what is his expectation for the market to be doing in terms of risk on and off flow? So if you guys tell me in the chat right now, do you think he's trying to trade risk on flow or risk off flow? I think there's a bit of a delay in the questions. Just generally how the stream works, but yes, risk on. Okay, good. Hopefully that was me explaining this well, or probably you guys know already. Anyway, okay, so yeah, everyone's correct here, risk on, perfect. And you can see how the markets are moving, okay, they're breathing. So I just want you to guys think, it's like a breathing organism, like this accordion, okay, of how it's moving in and out. Of how it's breathing. So you'll expect one market, especially like the S&P, to do like deeper pullbacks. It'll be more aggressive, especially since it's so illiquid. Look at the kind of for those who traded the S&P during prime time, during the cash period, it'll be bid and offered 150, 200 lot. Okay, the S&P here is literally 10 lots bid and offered. I mean, it's super thin. It's icy. Okay, it's gonna skid around a lot. Same goes for the bonds. I mean, the bonds here, if you look at the bid and offer in the 10-year, I mean, the 10-year is literally in normal prime time. The 10-year is like 2,000, 3,000, 4,000 lots bid and offered. So the 10-year is crazy thin. For this period, the same goes to the 30-year as well, the ZB. So you can see how. Okay, let me just pause. So all of a sudden, that was the trade. He came out, but now you're wondering why did he just get out? Why did he just puke his position and now he's actually reversed a small amount? This is because we were trading, and this is the very difficult part about trading. Every event is different. Sometimes you're trading pure, like, very obvious, there's a virus vaccine, okay, risk on, and the S&P will go to the moon, these bonds will dump, and so on. When you're trading this kind of event, it's probably the hardest kind of events to trade, because you'll constantly have Bloomberg says, Trump is taking the lead in this state, Trump's going to win, and then the CNBC comes out and says, oh no, but then we have this information from blah, blah, blah. And then the market will suddenly care about one piece of information and not care about the other. So he was hearing all this information from different sources, and he was reacting to it. So the markets were sort of there, but they didn't really break. But I mean, this is also, now I'm going to talk a bit about this important part here about his P&L, where you want to have a bit of stamina with these kind of events, because you don't want to go like you know, you don't want to go all out, all in, like on the first sort of on the first kind of flows. You want to sort of take advantage of the mini flows that come in and just slowly build your day. And you'll see this now in this recording, how the trader here, he built his day. We're building now from 7K, but he's over time, throughout the course of the night, he built the whole day into 45K. And that comes in waves, that comes in chunks. Okay, so just how the market breathes in and out of risk on and off flow, his PNL will sort of breathe in and out, but just generally, you know, he's trading it actively and proactively. It will trend throughout the night up to about 45K on the session. So very nice, healthy amount for the day. So very quickly, I think I got a few questions in now, so I'll take a quick pit stop now and just do a few more questions. So yeah, we're getting a few questions about the last traded quantity column on your DOM or ladder. And what is it? So yeah, 100%. I'll explain this, and this will tie in very well into someone who asked, what is the difference between just looking at the ladder and then plotting a line chart of closing price, you know, at the end? So perhaps we can just say, you know, the difference between looking at charts or whatever. The amount of information that's there on the ladder will blow your mind. And this will be a bit more obvious actually when I show you another recording, this time on the jigsaw ladder. Okay. On the jigsaw ladder, you'll see a bit more of order flow information, which is, I think, for beginners, really amazing, and for anyone really to use. But just when you're learning order flow, it's amazing to just understand that information. So the last traded quantity just shows you how many people, importantly, aggressive initiative-taking traders came in to lift that price, or to hit the bid. So how much traded into that price to take it out and so on, because that's always going to be very different. You're going to have one participant who's going to come in and sell, bedroom traders, they're going to sell one or whatever. The market's not going to care. You might have an institution who's going to come in and start buying clips of like 500, 1,000. They're going to come in. They're not going to execute that, obviously, most of the time, unless they're forced to liquidate or something. They're going to try and mask their execution because a lot of the time their size might be too big relative to the market. And a lot of institutions, they are graded. Their traders are graded on how well they can move, how well they can get their orders into the market without moving the price adversely. Because if someone came in and just started easily, like saying, I'm going to buy 1,000, 1,000, 1,000, 1,000, and the market's just going up, well, you're going to have a lot of people realizing this and just buy with you, and you're going to move the price really badly in your favor. Okay, so they'll always try and mask it, whatever, but generally you can see the last traded quantity, the kind of the firepower. So what's the firepower? Are people coming in? Is the market dead? Are people coming in with 2 lots, 3 lots? The market's dead. It's nothing. Or it has something happen and suddenly someone's selling the bonds, like huge size. Someone's come out with a cannon and just blasting the S&P or something with size. And this is the information you lose on the chart that you don't see. Of course, yes, you can see it on footprint, and it is very powerful when you combine it with the footprint, which we'll do again in the stream a bit later. But there's so much information just by looking, just your brain naturally understands these kind of relationships and patterns and flows. Seeing the last traded quantity, understanding that all of a sudden we've gone correctly, as John B says, it shows you momentum, speed, and volume. Now the market's moving, instead of with 10 lots, it's moving with 100, and we just keep going. Okay, so just to tie in those questions for you guys. Okay, just to go up all the way. Some Valentine's there. Okay, so I think I don't want to get lost in a few of the comments. So guys, if I skipped your question, if I didn't answer, just show it. Don't spam, but show it every so often. I'll try and get around to it. Dante, yes, color coding based on ladders. So I do my color coding a bit differently. Everyone does the color coding differently based on what they do. So I believe in this case we're doing what have you said? Yeah, probably commodities. It looks like yellow, the currencies in red, the bonds in orange, and the black in the equities in black. Okay, so let's keep playing. Okay, so he's kind of reversed because there's some kind of thing, but it's not very interesting. In this place, the market doesn't really, it just flatlines. So notice how we just came off. You know how previously we were, the S&P, was moving with more intent. The bonds were moving with more intent. There was more momentum, and now we sort of stalled. And now the S&P is like, it sort of is taking the momentum out of that move. And because it's kind of reversed, there's probably some kind of headline. We're thinking there's going to be a quick squeeze on people who were in the same position as him. Okay. So, and yeah, just to move the stream along, this recording is like 6 hours, 7 hours long. No, 40 hours long. He recorded like the whole 3 days. So there's no point playing that. So let's just skip to more important information for us. Okay. So how is he traded? Let's check his P&L. Okay, so you see, he's up 7, up 5, whatever, but it doesn't matter because he's trying to thread his way into. He's trying to needle himself, trying to understand, because now these are like small flows. The market still hasn't decided exactly what it wants, what the results will be between Trump and Biden. So he's trying to feel his way into understanding look, again, this kind of thing where you can see how the S&P is a bit more jolty, aggressive, trying to take out the session highs. You can see here at 97s. And you can see this is the kind of relationship you're looking for. As we're trying to take the S&P, notice how the S&P will try and pop the highs. And the 30-year, this orange on here, is simultaneously also trying to itch to take the lows. And this is the kind of relationships you will see, where if one market pops the highs, a few seconds later, the other market that's correlated will try and do the same because it's correlated. So often this pure edge in just being fast enough in spotting your peripheral market doing one thing and then just doing the other thing in your main market, or perhaps the one you're trying to execute in. But if you understand the perspective of participants or the market, just try and think, what's the market trying to do now? It's again trying to bid. The S&P is trying to catch a bid. The 30 years, the bonds are trying to come off. So there's still that feeling of risk on flow. Again, notice the Spooty S&P found another bid. We're now through the lows in the bonds. If the bonds are now taking out fresh lows, there's now people selling worse and worse prices because they're confident. The sellers are confident they're going to keep going. That requires new sellers to come in and sell at market at the lows, okay, which is very aggressive. So if the sellers are now thinking, okay, this is it, this is going to be the move, okay, that's a powerful information that you can figure out, okay. But again, there's this unwillingness to sort of commit and figure out what's going on, and this is now a good part to really understand. I'll leave this running. If you look at the kind of his risk management, his position sizing, he hasn't committed fully. He's very light right now in the S&P. Perhaps he caught much better prices in the bonds. And if you notice, sometimes not only will he be short, let's say the 30-year, he'll short the 10s and then be long S&P. So he's in 3 markets, okay. But he hasn't committed that much. He's short, not that many in 12 in the 30-year. He can do much more size, but he's letting the positions to just play out. He's not so obsessed with being offside, big size. And obviously, as risk management, you obviously don't want to be offside with all your size, right? You want to be super lean when you're offside. And you can see how he's willing himself. He's willing to be lightly, a 3-lot, somewhat, decent amount offside in S&P because he is onside. He is in profit on his 30-year position, so he can position himself much more flexibly than if you're in one market. And this is the power of trading multiple markets, because one might go, like the S&P might go, then the bonds go, then another market goes, and so you can never really predict easily which one will go first. So if you diversify between your entries in which one, you have this ability to sort of be more patient. If one of your positions, like in the bonds, is really on side, but you're slightly offside the S&P, but you think the S&P is going to catch up, then that's fine. You can stay in. You don't have to get out and be like, oh no, I got out. And then the second you get out, the market rips and you're not in it and you miss out and so on. So that's the kind of way to sort of as a sort of a way to play tactics, to really, to diversify of how you get in and out. As you can see now, the S&P just failed to notice how the S&P has shifted its personality. It's not really finding that sort of that momentum to just really drive and to come through. And you can see he's just now just completely cut his S&P position, but he's okay because he took you know, a good few ticks out of the 30-year. So again, this is the kind of, I've actually opened it with a very difficult kind of order flow, but this is what it is, you know, in these kind of events where it's not like a one and done. Okay, here it is. Here's the information. The market just goes crazy, and then that's it. It's these slow sort of moves. But the thing he's trying to gun for, the thing he is not really interested in. This P&L is basically nothing. Okay, from his perspective, it's not. He doesn't care. Okay, what he's trying to get into. This is only a byproduct of him just his P&L, if he was up this amount or down this amount, it's kind of the same. He's not really interested in this kind of P&L yet. Okay, what he is interested in is just making sure he is in with something when the main rip, the main boom. You know, the market said all the firepower, all the participants are in, and he has something in, because if he is in proactively in one market with decent size, then you can scale in, and you will not move your average entry price to worse positions, you know, as you know, getting in first time later on. Okay, so it's a really way to just sort of breathe in and out as the market's breathing, and then when the real flow is there, he's going to increase in size massively. And that is I think one skill the senior guys can do very, very, very well. They're so dynamic in going really, really big when the meat is there, when the you know, when the opportunity is there. Again, I mentioned the other stream, being really asymmetric with your risk. You know, when it's so worth it, they will put on huge size and not hesitate and just go for it. And when it's not very clear, the probabilities are like still, you know, not maybe 50-50 or so on. They'll be light on their feet, and maybe they'll be in with one market or only two, not in 5 markets, or they're going to be with one clip. Small size or something. So this is him trying to feel his way into the trade. No, to answer your question, Dante, no, this isn't them. We're going to show you a recording with them trading the Italian risk events in the past few weeks. This is someone I don't think you've seen before on YouTube, on our YouTube videos. This is a trader, Andy, from the floor, from one of the senior guys with his recordings. So if I now just keep playing, again, see how the market's now oscillating between these kind of flows. It moves one way, thinks, okay, risk on, then it dies out, and then it sort of shifts, and then it sort of goes the other way, risk off. This is just because of the way the headlines were coming out. You know, the Florida numbers were coming out, the numbers in Texas later, or Wyoming, or whatever, or in California. You know, the way they were coming out throughout the night. It was just really affecting it. And basically the real moves didn't really come out until we actually knew for sure if Biden's got it, or Trump's got it, or something. So you can see him, you know, just trying to, you know, be a bit more proactive with his entries. But for now, let's move a bit on. Okay, so this is now moving a bit later into the London night. So this is now about midnight, which is about 5 or 6 US time. So again, it wasn't still very clear. I think, unless one of the US guys or can correct me on this, but I think from the top of my head, I can't remember. Since we were all there trading this in the office overnight, I think we all fell asleep at like 3 or 4 a.m. I can't remember. I think I fell asleep at like 3 a.m. For like an hour or two. But anyway, so this is, yeah. So again, you know, he's trying to feel his way into. You see a short, very tiny size in S&P. He's probably on side, and you can see here, look, did you see there how the S&P was building up momentum and selling off, but he's not really selling S&P. What did he do? You know, he's sticking and trying to increase the size in the 30-year, because he understands that correlation. Instead of selling worse prices in the S&P, he can get much better prices buying the bonds instead. And because of that, he can it's much more efficient from the way you handle your leverage in that sense. So you see how, again, like an accordion, the S&P was a bit more aggressive, a bit more getting offered, and then we had that pop in the 30-year. So the S&P, you know, was coming off, and then we had the pop. But what happens now when the S&P pulls back? Okay, do the bonds pull back? Do the bonds hold? And what you'll notice, I think it was John B who said earlier that the bonds are a bit more sticky usually. Unfortunately, because they're thin overnight, they're not as sticky as they can be, but they'll hold the highs. So notice how the ZB here has held the highs really beautifully. It did come off a few ticks, but it never put our trader off size. There you go. You see how the S&P is coming off, and now he can be a bit more aggressive in trying to just sell directly, just at market, even though it is skewing his entry price. Worse, it doesn't matter, because this is the kind of rips. This is the rips you want to be positioned for. Okay. So this is what I mean. You don't care about that 7K at the beginning. You're trying to position yourself a bit for the real meat at the beginning. And you can see here how he's trying to just take nibbles out of his much stronger position in the 30-year in the US bonds. And for those of you, who are here at the beginning, now you understand this kind of correlation. That was a perfect example of how when the S&P comes off, you have that bid, that buying in the bonds because of that risk off flows. Okay. And that's what he was trying to position for. That's what he's trying to gun for. And this is the thing about trading in S&P a lot of the time. I'm sure most of you here just trade the S&P. It's a very rotational, it's a very squeezy kind of market a lot of the time. And by being positioned, he has another position now in the US 10-year. So he's now long in both the 10-year and the 30-year bond market as well. And because he has his position, he is now trying to be a bit more patient with the S&P and just let it do its own thing and go. Risky, yes. The entire stream will be available later, so don't worry about keeping your special Valentines waiting for too long, because no, it will be for sure. And we'll definitely have highlights and stuff for the stream. So okay, so here we go. So now you can see how he built up. He's still trying to, he's building up his position, his day very slowly. He's not being a kind of mistake I've made a lot of the time, being a bit more junior, and a lot of other guys on the floor. We trade the risk events. There's not enough stamina, and we think, oh, there's the first move, and we're like, that's it, and we all get eager, and we basically we put in too much too aggressively at the beginning, and then we probably are down a bit. Then we take a loss on that, a bigger loss, and then we're too hesitant to put on the next trade, and so on. But he's being proactive because he knows he's going to be trading this for the next 8 hours. He doesn't have to kill himself to go all out on the first headline when it's nothing certain for now. There isn't something definitive. So you can see how his P&L is oscillating in and around, but it's okay. He's on side and he's building up his day throughout. So again, if now I progress to, I think this is perhaps the best example of this recording, if I remember this correctly, of how the market will now sort of rip and how the correlations will come in and out. There we go. So you can see how, if everyone's, I think you may have missed that, but you can see how just as the S&P came towards those lows, he just added a few more. He was adding to his 30-year position. He didn't bother selling the low in the S&P. He bought the bond as a response to that move. And now watch. All I want you guys to watch is look how the S&P tries to take out lows, and the bonds will try and take out the highs. And one thing you'll also start doing is, you notice that if I'll show you that in a bit, but I don't want you to miss this correlation flow. So again, look how the S&P is just taking out lows, and the 30-year, the bonds are taking out the highs. So that's the relationship he's going for. And you can see how he's putting his limit orders here. Very small size, just to flick him out, because he's expecting the bonds to pop these highs. And you might pop the highs very quickly, and you might miss it if you're waiting to do it manually. So he's left his limits in just to if the market sprays a bit, and then he's just going to get flicked out very nicely. So you can see his kind of intention based on how he's layering his orders. And then in this time, of course, you're reaching 1 a.m. Here in London at that time, so it's probably 5 or 6 now, going into the US period. So again, SPU coming off. And watch how the SPU, every time the SPU tries to make that low, fresh lows there in the session, the bonds will catch the bid. There you go. The 10-year is now tried to take out the high. The 30-year is doing the same. So this is how just purely, so not really looking very specifically at tick by tick. You're just interested on how like the market's just breathing, how it's discounting, how it's understanding. And by the way, if I just pause this very quickly, this is why he's moved his risk ladders, because he told me very distinctly. Yeah, that's right, Stephen. Sorry, 5 hours I think it was. I couldn't remember for British summer times 5 or 6 hours, but yeah, anyway, around there. But yeah, correct me with the timings. So you might have seen him look earlier how he's actually moved. So at the beginning of the stream, here, you notice he had he had the Aussie dollar, he had copper, but he's actually added the US 2-year bond. So he's looking at the short end of the market, because he said, I have no, Andy, who was trading this, if you go to his desk, he literally has, I think, 4 screens out of just for ladders. He's got more screens for charts and whatever, but I think he's got 4 screens just literally of this. Okay. But he can't record all of them because of the way the computer is going to lag and whatever. He's scared that it's just going to lag and whatever. But he also, so he has so many ladders everywhere of every single market. And he says with these kind of events, you just don't know which market will take the lead and drive all the other markets. So when he was fiddling around on the left side, you can see earlier before I paused, he was actually moving the US 2-year bond. So he probably at the time, and from what he told me, he was looking at what's leading, and the short end of the market was starting to lead the bonds a bit better. It's sort of, if you were watching the 2-year, you could then execute the lagging part in the 10-year and add more size into your trade comfortably, because you know it should do that catch up, essentially. And again, going back to what I was describing at the beginning of the stream, the Aussie dollar is a risk currency. It's coming off the same way the S&P, we just saw it was taking out the lows. So it's not a surprise, the risk currencies were coming off. And what is also making new lows? Copper. Okay. So again, we're having risk off flows. Copper is taking out lows. The Aussie dollar is taking out lows. The bonds are up. So all this kind of flow makes sense. And this is why I wanted to show you guys this flow. It's very closer to what you'd expect as textbook in terms of how the markets move, usually, of what good flow is. So if I now just play a bit. You can see also gold is starting to get a bit more haywire, again, because it's so liquid. This is actually a good time to talk about liquidity. Look how thin. Gold is always thin. It's never like, but it's very thin. I mean, it's as little as it could be, bid offered. It's got 1 lot. So all it takes is like literally you guys in the chat right now, each of you could come up with a 1 lot in gold, 10 lots, and you could take out, if you guys took out, you see 1 shoot, you guys collectively in the chat right now took out, you could take out a few prices in gold. Of course, if you guys in the chat, 10 of you right now, got a lot each, 1 lot each, you wouldn't even move the bonds, okay, because they are more liquid than gold, okay. And as mentioned last stream, as well, liquidity plays a big part in how moves play out, and obviously that was a lot of the premise based on the short squeeze in GameStop as well. So yeah, Klein, and thank you for that, Stephen. Yes, it's Andy, yeah, one of the senior guys who was trading this event at the time. Well, actually, we all were, but just showing his recording, since I managed to convince him to get the recording for the stream. So that was very nice of him to lend me it. Okay, so basically now if I speed it up a bit more, and this is the last sort of segment, guys. So once we finish this one, I'll now show you Dem's trade of trading the BTPs and the sort of the Italian risk headlines we had in the past few weeks. So now he's, if I pause now very quickly, he's now built up Trey. It's the US elections, the November ones that just came. So this is the night leading up to the elections. So as you can see now, he's built up a decent. He's built up a decent day. So he's coming towards. Obviously, he had no idea that this is. He was going to be up 45k. He had absolutely no idea he was going to be up this amount. But obviously, since now I have the recording for you guys, this is how he was coming towards the end of the session of trading. And as you can see, it's now literally 10 a.m. the next day in London. So he had the stamina to pace himself throughout the entire night, to trade, to just build up. I will show you the notepad for Hawkish and Dovish, not to worry, guys. Yeah, don't worry. So he was pacing himself really, really well throughout the night, okay? Slept a few hours, whatever. So this is how you were trading throughout the night. And we started moving as the market sort of digested the now, I think at this time, if I remember correctly, I think it was the markets waking up and saying, hang on a minute, there's now no clear answer between Trump and Biden. And I think then the issue with Georgia and the voting, it was becoming apparent, and the markets were like, well, okay, there's basically no resolution, and now we're going to have several days worth of trading past the official election result to figure out who the hell is actually going to become the US president. So, yeah, so, okay, so he's done the bulk of his trading, the bulk of his sort of like risk taking, so he's not going to be, yeah, so yeah, he was exhausted. All of us were like basically dead. Yeah, so as you can see, he's not going to be as crazy in like trading whatever. And the markets, as we're coming to the European session, the Asia Pac traders digested the information they traded. The Europeans are now coming back and they're trading this and each market. So as you can see, he's trying to trade the sort of the afterflows a bit in short, very, very tiny size a bit in the euro, just because it was good flow. I think he was trying to get short in terms of gold, but this is very small size because he was trying to feel his way in to see if there's any sort of afterflows in the markets. But that's how he sort of traded throughout the whole night, and he was trying to sort of feel his way in into this event. Okay, so thank you very much, Andy, if you're watching the stream. For I think that's the first video we showed you guys from Andy, and he's someone with ridiculous experience. He's traded, I think, since literally like 2001 or 2002. He's one of the old breed, and he's one of the guys, actually, I think, if we guys are very happy, I think he's also going to be happy to come onto the stream in the very near future to just ask him whatever. So if you guys ever have a specific question from this thing, just write it down, and hopefully if we do like an interview or like a little chat with him, two-way chat, then we can definitely ask him for that.
If you find this video interesting, if you want to go deep into the Axia training method and how our trading team of 7-figure traders develop setups and strategies and how they learn to build the most profitable trades across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the VEL concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.